Hey everyone, it's Vishal here from Livewire, and by the time you're watching this, it's probably my birthday. Yep, the big 4-0. And I know, I don't look a day over 39. Now, in all seriousness, turning 40 has made me reflect a lot about life, money, and why people end up on such dramatically different financial paths. And these reflections have come after conversations with a couple of people who you'd think, based on their incomes, should be doing really, really well. I know couples on $300,000 plus combined salaries who are living paycheck to paycheck with no assets to show for it. I know hugely successful business owners facing garnishment for not paying their taxes on time over the years. And executives who made a huge mistake, lost their job, and now their life is sadly crashing down around them. It just goes to show that when it comes to getting rich, investing is just part of the equation, and I'd argue the easiest part of that equation. So today, instead of the usual stock tips, I want to share 4 lessons for people in their 20s to their 40s. And if you're a parent or grandparent watching, please pass these on to your kids. I've based these tips on an interesting framework out of the US called the wealth ladder, which dictates your net worth across 6 levels, starting at $0 to $10,000, moving on to $100,000, $1 million, and then beyond. Hopefully, with these insights, you can get to that $1 million level and then cruise higher and, very importantly, not fall off the wealth ladder. Let's get into it. Okay, so lesson 1 is to live broke now so you can be rich later. When you're young, your biggest financial superpower is time. Every dollar invested in your 20s does 3 to 4 times more work of a dollar invested later in life. So if you invest $1,000 per month in your 20s, and we assume long-term ASX 200 returns of about 8.5%, you will hit roughly $1 million by your early 40s. But if you start that journey in your 30s, you then need to invest 3 times as much. That's why your 20s shouldn't be about becoming a stock-picking genius. Your job is to live well below your means, choose a career you genuinely enjoy, get damn good at it, and network hard. Now, I can't stress that last part enough. Your social capital is often worth more than a degree and can help you climb that wealth ladder quickly. I personally never went to university. I just networked my way into higher and higher paying jobs, along with working hard. Lesson 2, time in the market really does beat timing the market. Now that I'm 40, I can confidently say I wasted years of my life trying to time the market. My best investment is the one I barely touched, a property I bought back in 2012 in Western Sydney and simply held. Over 13 years, it steadily compounded and quadrupled in value. But my worst investments were the ones I kept fiddling with in my equity portfolio. I panic sold. I sold too early. I tried to be the Mr. Smarty Pants who thought he could beat Mr. Market. I bought CBA at $28 during the GFC and I sold out at $40. It's now $150. I bought Shopify at a split adjusted $5 and sold at $7. It also hit $150. By doing this, I'm pretty sure I've cost myself quite a few long-term returns and triggered unnecessary capital gains tax. It was all just a waste of time. But I take heart from Warren Buffett's latest shareholder letter, where he says, "Don't beat yourself up over past mistakes. Learn at least a little from them and move on. It is never too late to improve." You can do the same. If you've done your homework and own a portfolio of quality companies or ETFs or just a good property, often the best thing you can do is nothing. Over time, equity markets have transcended past every negative headline, whether it was a war, a financial crisis, or a pandemic. It just takes patience, and I'm personally getting better at that. If you truly master lessons 1 and 2, I reckon you can hit $1 million on that wealth ladder by sometime in your 30s. Lesson 3, don't keep up with the Joneses. Now, what I notice is people stall at around the $1 million mark because lifestyle creep quietly halts their momentum. You earn more, your home value goes up, your portfolio grows, and suddenly you deserve things and your expenses rise. The fancy caravan, a brand new truck, the holiday home, the $100,000 boat that you use maybe once a year. And I get it. When you see your friends buy a boat and post a story about it on Snapchat, it's hard not to get jealous. And in our consumer-driven economy, e-commerce lets you buy things with a click. Fast financing lets you buy and take on big chunks of expensive debt at the speed of light. But remember lesson 1 about living broke in your 20s. It is designed to protect you from this moment. That discipline should help you maintain a healthy gap between income and expenses. Now, to be sure, I'm not saying don't buy nice things and live a boring life or something like that. I'm against buying things for the wrong reasons or to just keep up appearances. If you want to spend time on a boat or a beach house, go pay $10,000. Rent it out for a week, rent it out for a month, go enjoy it. Hand back the keys and never worry about maintenance and depreciation and insurance and all that jazz. Instead, use your capital to keep working for you. Warren Buffett still drives an 11-year-old hail-damaged Cadillac, and the wealthiest people that I know still all drive second-hand cars, and they put their excess savings into ETFs or property investments, and they let the income from those investments fund their holidays. Lesson 4, don't blow it. This lesson is criminally underrated and is particularly applicable to people in their 40s and beyond who have done all the right things to climb up that wealth ladder and get to $1 million plus net worth. If you own a home, you have a loving family, earn a good income, and you invest regularly, and your biggest debate is shares versus property or an equal weight S&P 500 ETF versus a market-weighted one, you've already won the lottery. Who cares? Millions of people would trade places with you instantly. So the real question becomes, how do I not mess this up? I've seen people fall off the wealth ladder and crash from more than $1 million to close to zero in the blink of an eye. And I want to share 3 examples I've encountered over the past years. These are all real-life examples. The first is a sales executive who decided to steal commissions from his own sales team. He got caught, fired, and he ruined a 6-figure career and his reputation. The second is a Sydney technology worker on $300,000. He was a permanent resident who had an Australian wife and a child. He was this close to his citizenship, but one fateful evening, he drove home drunk from the bar and hit someone. His visa cancelled. His job gone. His family gone. The Australian dream gone. It cost him everything, including his freedom. And this last one breaks my heart, and it's a story of an inexperienced investor who YOLO'd his €1 million inheritance into shares of Beyond Meat, the year's most famous meme stock. His €1 million fell to $350,000 in just 2 days. He lost money that took a generation to accumulate. That was an inheritance, and he was meant to spend that inheritance to buy a home with his fiancée. Not only did he blow that money, but she left him as well. It just goes to show that staying rich is often harder than getting rich. And there you have it, 4 lessons from turning 40 that I hope gave you some insights about managing your money that are a bit out of the ordinary. Your investments are going to compound quietly in the background. Your real challenge is in getting a good job where you earn a decent amount of money, how you manage your expenses, and how you inevitably manage some of those challenges that are going to come your way. I hope you enjoyed this video. My name is Vishal Teckchandani. I'm from Livewire Markets, and if you have some insights or a golden lesson to share with us about managing your finances and avoiding the blunders along the way, please do drop it in the comments below. Have a great day.